Good afternoon, everyone. Welcome to SGX SICOM Rubber Futures and Options webinar series. I'm Kenneth Ng from the Singapore Exchange, and I'll be your webinar host and moderator. Today's webinar is on advanced rubber options trading, comprehending options Greeks, and advanced trading strategies. Speaker for today is Mr. Srinidhi from DI2I Private Limited. Before I hand over the presentation to Sri, I'd like to give you a short update on SGX. Webinar disclaimer. Please take note of the disclaimer pertaining to the collection and use of information that you have provided, prohibition of use of information in this webinar by individuals and entities located in certain jurisdictions, and disclaimer of guarantees, representation, and warranties in relation to this webinar. A copy of this disclaimer is available on our website. There are 4 webinars in this series. If you have missed any of these webinars, you may visit our SGX YouTube channel for recorded version. Next, I would like to give you a short update on SGX and our products. SGX is an integrated securities and derivative exchange in Singapore. The exchange was formed in 1999 following the merger of the Singapore Stock Exchange and the Singapore International Monetary Exchange, or SIMEX. SGX is also a listed company, and our shares are listed on our own SGX Securities Market main board. We operate Southeast Asia's largest stock market with a market capitalization of over 1 trillion Singapore dollars. On the derivative market, we offer the most comprehensive range of Asian stock index, currencies, and commodities derivatives. SGX acquired SICOM in the year 2008. For some of you here from the rubber industry, you would know that SICOM was the rubber futures exchange in Singapore. After the acquisition, SICOM Rubber Futures is now traded under the SGX platform. Because of the long history and strong brand name in the rubber market, we still retain SICOM's brand name in our rubber futures products. SGX is headquartered in Singapore, and we are supported by 9 representative offices globally to service our global customers. SGX's commodities products can be broadly classified into these 6 broad categories. We have the world's most actively traded iron ore market outside China, where we trade an average of 12 million metric tons of iron ore a day. For more information on SGX commodities products, you may visit our website. SGX SICOM Rubber Futures is the global benchmark for the rubber industry. Our SICOM Rubber Futures prices are used by tire makers globally to price 75% of rubber raw materials. SGX rubber products can be broadly classified into 3 broad categories. For exchange-traded futures, we offer the world's only US dollar-traded TSR20 and RSS3 futures. We also offer the world's only TSR20 rubber options. In addition to exchange-traded futures and options, we also have 3 OTC rubber forwards based on standard Thai rubber, standard Malaysia rubber, and standard Indonesian rubber. Quick statistics on our rubber contracts. We trade an average of 45,000 metric tons of rubber futures a day. On very active days, the volume can be as high as 100,000 metric tons a day or more. We had a record month in March 2020, where we traded a record 1.18 million metric tons for the whole month. This is roughly about 10,000 lots of futures per day. This is a screen capture of the trading activity of our TSR20 rubber futures on the 2nd of April 2020. As you can see, all the contract months are traded and with good open interest. This offers hedgers the flexibility to choose the actual contract months to hedge their exposure. For calendar spread traders, the trading activities along the whole forward curve present spreading opportunities. These are our contact information. Please feel free to contact us if you need more information. I will now hand over the presentation to the speaker of today's webinar. Thank you.
Good afternoon, everyone. Hope all of you are keeping well and staying safe. So the plan is over the course of the next 45 minutes to cover advanced rubber options trading strategies. I'll try to speak loudly and slowly. As you may appreciate, it's not necessarily an easy concept to be delivered in 45 minutes. Even within a day, it's difficult. So let alone in 45 minutes. So what I've tried to do is to touch a bit on the basics, to try a bit, touch a bit, kind of scratch the surface on option Greek and how it's relevant to traders of this contract. And finally, to kind of give a broad picture overview of the various strategies that are possible using options, and then to delve into some of the very few examples. So again, more than happy to walk you through in greater detail outside of this presentation should any of you be interested. So moving on, so as I said, 3 parts to my presentation: fundamentals, option Greek, options trading. So before I jump in, a quick introduction to what I do so that you have a context to where we come from on this. So a big part of our business at DIY is risk management consulting. So we help our customers, essentially commodity market traders, in identifying and managing risks in trading and settlement on the physical side of the business, and also for participants who are purely paper trading as well. Second part of our business is business and technology consulting. So this is where we help our customers, or mainly financial services providers, in designing new products and platforms through both our business and technology consulting capabilities. Finally, we also build bespoke technology solutions. So in fact, we've built for one of our most recent clients, volatility forecasting tools using large models. So these are very bespoke kind of services specific to that company and their specific business needs. So moving on, a hallmark of a good risk management company is first a disclaimer. So jokes aside, so what I want to convey here is that whatever material is carried within this presentation, so we don't watch necessarily for the content of third parties. 2, this material has been crafted as general education purposes, for general education purposes only. It does not address any specific investment or risk management objectives. And as any financial investor would tell you, past performance is not necessarily indicative of future performance. And finally, all examples used in this paper are hypothetical and used for explanation purposes only. The content in this paper is not investment advice. All right, so with the disclaimer in place now, so moving on, trading, ultimately what is trading? It's essentially an expression of views. Question is, what views do you want to express? You may have a view on direction, meaning I expect rubber prices to go up, or I expect rubber prices to crash further. Or you may have a view on term structure. I expect the front 2 months to be going up, but not necessarily the rest of the curve. Or you may have a view that from July, prices may rally, but not the rest of the curve. So for the first, you have the existing futures contract using which you can participate in the market, or you could even use the physical itself. For the term structure, again, the existing SICOM futures contract allows you to play across the 12 contract months that SGX has made available on the exchange. And finally, a view that you may want to express is one of volatility. So one is the direction in which the price might change. The other is a view as to the speed at which it might change. That again presents itself opportunities for someone to trade. And how do you trade volatility? Options is what makes it available. In a sense, why options? Because it helps you to widen your trading sources. So starting with the first part of the presentation. So what I want to touch here on this slide is all the basics. I know Expiry has done a great job in the first 2 sessions covering these, but this is for those who may not have necessarily attended that, and just to ensure that everyone's on the same page. As all of you know, futures are essentially obligations on both the buyer and the seller. Distinctly, options is different in that it gives the right to the buyer, but the obligation remains on the seller. And there are 2 types of options, as you all know. Call options, which gives the buyer of the call option the right to buy. Then put option, which gives the buyer of the put option a right to sell. So how does this pay off? What does that look like? So you could be long a call option, meaning you have bought a call option. What do you get? A is first you to pay a premium to buy a long call, to buy a call option, and it gives you profit from rising markets while helping you avoid losses from falling ones. While short call, if you're selling a call option, what happens? Then you have the obligation to offer protection. In consideration of offering that protection, you get to collect premium upfront. Thirdly, you could take a long position in a put option, meaning you could buy a put option, whereby you need to pay a premium for what? For getting protection from falling markets. So typically, this is what a factory might want to do. So you're already looking at 110 cents per kilo. What if the prices fall below 100 cents? So to be able to secure that kind of protection, a producer typically would buy a put option. And then the fourth possibility is you could be selling a put option. What are you going to get as a consequence? You get to collect premium upfront to offer protection from falling markets. So graphically speaking, that's how it gets played out, right? So you have the long call, the long put, short call, short put. Again, as you can clearly notice, when you have a long position, you have unlimited upside in some sense and limited downside. But if you're on the selling side of it, you have limited upside, unlimited downside. So I'll perhaps pause for about 5 seconds just so that you absorb this before we move on. So there are two concepts, right? Many concepts, two key of them, moneyness of an option and option expiry itself. Starting first with moneyness. What exactly is moneyness of an option? You might have heard of three terms in this context. One is ATM, at the money. What does it mean? If an option is said to be at the money, it implies zero cash flow to the buyer if the option were to be immediately exercised, right? So I have an option, I have a call option. If I exercise it now, I get zero cash flow from it as a holder of the option, as a buyer of the option. Such an option is said to be at the money. An option that is said to be in the money is for a buyer of an option, it results in positive cash flow the moment you exercise it. If I were to immediately exercise now, I get a positive cash flow. Such an option is said to be in the money. And finally, by exercising an option, if I have a negative cash flow as a buyer, such an option is said to be out of the money. So if you take an example, let's say I have an option at 116 strike price. So if the current, let's say it's a call option, right? So if the current market is trading at 118, I get to buy rubber at 116. So I'm in the money. If I exercise now, I get 2 cents right away. So if the market is trading at 114, I wouldn't exercise the option. If I were to exercise, I lose the premium. If the market is at 116, then I get zero cash flow stemming from the option itself. So such an option is said to be at the money. So graphically speaking, so depending on which option do you have, what position you have, whether you're long or whether you're short. So your long call, long put, so the different payouts, come out to be the way it is shown on the chart. So in terms of expiry, so there are two types of expiry. There are many types of expiry. Two common ones are European expiry and American expiry. So an option that has a European expiry style essentially can be exercised only at maturity of that option. Whereas with an American option, it gives you the right to exercise at any time, even before expiry. So the American option gives you a lot more flexibility. Just so that you all know, so the SGX rubber option is of European expiration style, meaning you can exercise it only at the maturity of the option. But there is nothing to stop you from being able to trade in between. You can buy today, and let's say 10 days from now, you notice that the premium at which you had bought versus the premium at which you can sell, the prices have gone up, the premium has gone up. There's nothing to stop you from selling the option 10 days from now. Okay, moving on. Option prices have two components, intrinsic value and time value. So intrinsic value, so for a call option, it is the maximum of the futures price minus the strike price or zero, whichever is higher naturally. For a put option, it's maximum of or the higher of strike price minus the futures price or zero. And the time value, essentially, how do you compute the time value? You look at the total option premium, you reduce the intrinsic value, whatever is left is essentially the time value. So in terms of an example, if I were to price an October 2020 116 call, 116 call, so this is assuming a certain level of constant level of implied volatility, and let's say the underlying price is a C level, 116, 120, 112. As you can clearly see, the first one is ATM. The second one is in the money at 120, while the market is trading at 116. And the third one is out of the money, OTM. So the total premium turns out to be 8.5, 10.8, and 6.5. So the intrinsic value, as you can notice, only the option that is in the money has a positive intrinsic value. The other two have zero intrinsic value. The time value is 8.5, 6.8, and 6.5. By the way, all these are expressed in cents per kg. So the break-even point for these options. So if I were to buy an in-the-money option at 116, how much would the price go up by before this option is profitable for me? It has to, the underlying price has to go up to 124.5 and above for me to achieve a break-even and to move into profitability. Same way for illustration purposes, I have provided a similar structure for September 110 put option. I won't necessarily work into these details. Eventually, all of this will be made available to you, both as a YouTube video and as slides as well. So happy to take on questions should you have any further on. Okay, in terms of option price drivers, so there are 5 things that drive option prices. 1, underlying futures price. 2, strike price. 3, risk-free interest rate. 4, time to expiry. From the time at which you're buying the option and till the time until which the option expires. And finally, expected volatility. When you see a price in an option, the price that you see has an inherent volatility built into it. So that is what is generally referred to as implied volatility. So these are the 5 components that drive an option price. So why is expected volatility in red? There's a good reason for that, right? So the first 4 parameters, as you have seen, are essentially facts of life, so to speak, right? So these are observable parameters. So you know what the underlying futures current price is. You know the strike price at which you want to buy or sell. You know the risk-free interest rate as it applies to you. And then there is time to expiry as well. That can be computed between the date at which you are trading and the date at which the option will expire. And then there is expected volatility. That is you as a trader, your assessment of what volatility is to be expected during the course of the option duration. So this is where, this is an expression of view for all traders. So I could have a view saying that over the course of the next 3 months, this option could have a volatility of 30%, whereas someone could say, no, for all the reasons that I believe in, the expected volatility is only 15%. So that exactly is where there could be a divergence of view in terms of what the expected volatilities would be, and that is what results in a trade. So for an option that is priced at 30%, someone might think that this is overpriced and it can enter into a specific kind of a trade. Someone else might look at 30% and say that is underpriced. So this is where markets can have different perceptions of what is to come, and as a consequence, would trade into different strategies. Moving on. In terms of pricing SGX SICOM rubber options, as you all know, this calculator is available on SGX website. For the benefit of those of you who may want to access it, there's both the link and the QR code using which you can get to this page, and there is a zip file once you download, you get this Excel file. So essentially there are 7 steps, right? So you got to choose an option type. So you choose whether you want a call or put, right? Then you get to enter the current underlying price, which is in this case 118. Then the strike price, which in this case is 116. Then you get to choose the trade date. By default, this is set to as today. It picks up the current date. But should you want to trade at a future date and you're trying to plan accordingly, you may want to change that. Then there is the option expiry date. So this is for ends on 31st of August. Again, as you all know, what I'm trying to do here is to price an October contract. So the October contract stops trading. The last trading day for an October contract is 31st of August in the case of options. So the date has to be properly selected so that the time to expiry is properly calculated. Then you enter the risk-free rate as it applies to you. So I put 1%, which is very high in the current context. And then you enter expected volatility, 29% as an example. So what you then get to see as an option price is the premium, which is 9.3. Is the price of the option. Okay, on to the second part of our agenda, which is option Greeks. So essentially there are 5 option Greeks, and these are delta, gamma, vega, theta, and rho. So starting with delta first. So delta is what is referred to commonly as the first order derivative. Delta measures the sensitivity of the option price to the changes in the underlying price. For example, let's say rubber is trading at 115 cents per kg. If the price of rubber goes up from 115 cents to 116 cents, that 1 unit change is going to have an impact in how the price of the option is going to change. And that sensitivity is what delta measures. So for those of you who may be familiar with calculus, this is the first order derivative. By the same token, gamma is a second order derivative in that it measures the sensitivity of the delta itself to the changes in the underlying prices. Meaning, if you go back to the same example, when the price of rubber moves from 115 cents per kg to 116 cents per kg, how much would the delta change? As you may appreciate now, delta is not a constant number. It keeps varying each time the underlying price of the commodity changes as well, which is what makes options not necessarily behave linearly to the changes in the underlying price, but fluctuate differently, and it's a curvature that the calculus then measures, and that is represented by both delta and gamma. The third option Greek on the chart there is vega. Vega is the sensitivity of the option price to changes in the volatility of the underlying. Let's say, for example, when a trader buys into an option contract, the underlying volatility that was priced was, let's say, 25%. If the volatility in the market jumps to, let's say, 45%, the value of that option, the volatility embedded in the price of that option would spike. And that change is measured by vega. The fourth option Greek is theta. Theta is the dollar amount an option loses each day with passage of time. As Ekmeng referred to in his presentation, theta refers every option is a wasting asset basically, because it gives you an optionality to either to exercise in the money or risk being exercised or risk expiring worthless without being exercised. So theta represents for holder of an option the amount the option loses in value with each passing day as it inches towards expiry. And finally, rho. Rho is the sensitivity of the options price to changes in the risk-free interest rate, and that is represented by rho. As you may look at the chart, all the Greeks are in blue except for vega, and that's primarily because vega is not a Greek letter at all. So within the trading community, it's generally referred to as vega, but to academics in general, they use kappa, which is K, to refer to the sensitivity of the option price to the changes in the volatility of the underlying. So moving on, all derivative contracts, these futures or options, have Greeks embedded within them. The question is at what levels they are. So starting with futures first. So a futures contract has a delta, and the delta of a futures contract is always 1, which is why they're otherwise also referred to as delta 1 products. So long futures contract has a positive delta of 1, and a short futures contract has a delta of -1, which means if the underlying price goes up by 1 cent, the value of the futures contract also goes up by 1 cent or drops by 1 cent, depending on the trader being either long or short the futures position. However, with respect to options, as you can see as laid out on the chart, so they have different types of option Greeks beyond delta. For example, for long calls, having a long position, meaning if someone has bought into a call option, so they are exposed to a positive delta value. The gamma for them is also positive. The theta for long option holders is always negative. Whether it is long call or a long put, it's negative. And vega, which is the view on volatility, for long calls, it's positive. Likewise, for long puts, it's positive. Again, I won't necessarily go through each one of them, but this chart kind of sets out the Greeks in which they're embedded in different options position, depending on whether it is a call or a put, whether you're longer call or whether you're shorter put. Talking more of delta, right? So what does delta, besides being the first order derivative, what else does delta convey? One, as I mentioned, first order derivative. So those of you who have done calculus, so this is the very, very first order derivative. Let's say if the price moves by 1 unit, how much is my delta change? So that is the first order derivative. So the same token gamma is a second order derivative. 2, delta for many traders is also an indication of the probability of the option settling in the money. If you saw our calculation earlier, so that particular calculation had a delta slightly above 0.5. So it shows that it's almost a 57% chance of that particular option settling in the money. Meaning if you were to buy that option, you can be more than half certain that it will settle in the money for you. Delta can range anywhere between -1 to +1 depending on long or short option position, and naturally depending on if there's a call or a put. ATM options, at the money options, typically have delta closer to 0.5, plus 0.5 for long calls, and minus 0.5 for long puts. And again, I would like to emphasize here, right? When we talk of delta being plus 0.5 for long calls, the word that is important, the operating word there is long call. If you're selling a call option, your delta would be minus 0.5. If you're buying a long ATM call option, your delta will be plus 5. So what is positive to the buyer is negative to the seller. In the money options, typically have delta closer to 1, long call, plus 1, and minus 1 for long put. Out of the money options, typically have delta closer to 0. So at this juncture, I want to take a short break whereby we kind of switch across to a quiz. So part of the challenge is, I run these sessions quite frequently, more as face-to-face rather than as a webinar. It's hard to hold attention even when you're doing it face-to-face, also more so when you're doing it as a webinar. So if we could jump across to a quiz, let me share my other screen now. Kim, could you let me know if you're able to see the Slido screen now?
Yes, I can see the Slido screen.
Yes. So the question was not intended. So all of you, you could do one of the two things to access the survey now. Either you can take your phone, scan the QR code using the camera to get to the screen, or you can type slido.com, and once you get in, you'll get to enter the survey code, so to speak. So you could enter SGX CFO. And the question that you need to answer is, which among these are an estimate while pricing option? Which of them is an observable parameter? Which one of them is an estimate? Okay, we will wait for a few responses to come in before we move on. Kenneth, how many do we have on this webinar now?
We have 42 who have logged in.
Okay. So I hope we only have 9 responses. I hope the 33 don't have a challenge in accessing it. Perhaps in the interest of time, I'll give up the answer and we move on. So the majority is right. So it's implied volatility, that is an estimate. So underlying futures price, risk-free rate, time to expire, strike price, is that observable parameter as it applies to you. There is no estimate vis-a-vis those different attributes there. So if you move on to the next question, second of the 3 questions, as I just mentioned, delta measures the sensitivity of option prices to change in underlying prices, right? So the delta of a long call, is it positive, negative, or 0? The response is only in single digits still. I hope you're not finding it challenging or not put you to sleep by now. Okay, again, in the interest of time, the answer is right, clearly. So the delta for a long call is always positive, anywhere between 0 and 1. The same token for a long put is anywhere between -1 and 0. Final question. In the money option, have delta closer to 0, or is it +1 for calls and -1 for puts, or is it -1 for calls and +1 for puts, or is it +0.5 for calls and -0.5 for puts? Mind you, this is in the money, not at the money. So at the money is almost like a torch, right? You're roughly about there. Either it could be in your favor or against your favor, 50-50 chance. If it's in the money, so the delta tends to be more closer to. Okay, we have 14 responses in, clearly, you'll get it, right? So +1, closer to +1. Arguably, someone may argue that what is 0.7? It's more closer to 0.5 or 1. So the point that I'm trying to convey is as the prices rise up for calls, for long calls, the delta moves away from 0.5 towards 1. And for long puts, it moves towards from -0.5 towards -1. All right. Thanks for the participation in the quiz. So we jump back to our presentation. So moving on to the final part of our presentation. So extracting value from options. How do we extract value? Many ways. So by no measure can 1 hour webinar do any justice to the different possibilities that you have while trading options. One, you can profit from directional views. Similar to being able to participate in the physical market or in the futures market, options also allows you the ability to profit by taking directional views. If you think that prices of rubber will go up, what are the possibilities? You can buy calls or sell puts when you expect prices to rally up. Or you have a bearish view and you expect the price to come crashing. You could sell calls or buy puts when you expect prices to go down. So you're essentially expressing a directional view by so doing. Two, you can express volatility views as well. So you could arguably say, there has been news in the market. I know markets are going to act crazy, but it's hard to put a finger whether the market will go up swiftly or come down swiftly. So for those of you who may be familiar with other markets, for example, if I take an example of what happened in the iron ore market about 15 months ago, while we had a huge incident in Brazil, one of their dams had collapsed, everyone knew that iron ore market was set for a huge move. But which way would it move? Would the prices rally up, fall down? Was hard to say. So in a situation like that, options can be very, very helpful because you are now expressing that the markets will move at a rapid pace. Whether they'll move up or move down is something that we will not be able to predict, but this is something that you could profit from. Or you have a view that the volatility will fall for whatever reason. With all this happening right now in the current environment, you believe economic activity will shrink, contract, let alone recession, you even enter depression. And you think as a consequence, volatility will shrink. You can express that view by using options and profit from it. Finally, you can profit from mispriced options. The reason I have put mispriced in quotation is for a good reason, right? It's almost foolhardy to think that someone could be mispricing, but those possibilities are not, but it's not impossible for someone to misprice an option. An option could be mispriced for a whole range of things, right? I could, for example, have a very distinct and a radical view as to what the market would be, and as a consequence, willing to pay a price in support of that view, which to you, who has a different view of the marketplace, could be seen as a mispriced option. And that could be profit from, you could take a profit from that as well. So if we take each one of these segments, or rather, before I jump into that, so in fact, Ekme mentioned this as one of the resources by Sheldon Nattenberg. He has a brilliant book, Option Volatility and Pricing. For those of you who have not read it, if you are serious about options, it's worth looking at it. So in his book, so he has this canvas of the various different possibilities that you can trade with using options in different situations, right? So you have a market sentiment as one dimension. So either it could be bearish, neutral, or bullish about markets. And then you have different volatility regimes. Either you're in a low volatility regime, moderate volatility, or high volatility regime. So for each one of these, you have a range of strategies that you could deploy to earn money reasonably and safely, potentially. So if we move on, we remove each one of these styles, right? So in a low volatility environment, in a bearish market, what can you possibly do? You could buy naked put. You could sell out of the money call butterfly. You could buy in the money call time spread. Or you could enter into pair vertical spread, right? Or if you think the sentiments are neutral, hard to say, markets are flattish, moving sideways, then you could go buy straddle in a low volatility environment, or buy strangle, right? And again, I'm not going to read through every bullet on this list, but this is just to give you a sense of what possibilities are there for different volatility regimes and different market sentiment structures. And if you have a view that the markets are in a bullish state, you could buy naked calls, or you could sell in the money butterflies, buy out of the money time spread. So those possibilities exist. If you're witnessing yourself, finding yourself in a high volatility market, but the underlying market itself is bearish, then you could be selling naked calls, buy in the money call butterflies, or getting into bear vertical spread. Or if you think from a sentiment perspective, it's neutral, flattish market, you could sell straddles or sell strangles. Or if you're in a bullish market, which is also high in volatility, you could be selling naked puts and just collecting premium, and then delta hedge if necessary. Or you could be buying out of the money call butterfly, or sell in the money call time spread. But if you're in a moderate volatility regime, so then you could just be simply sell the underlying. Or if you're in a bullish environment, but moderate volatility, you could be buying the underlying. If it's moderate volatility and neutral, markets are moving sideways, what Sheldon suggests is that we go on a vacation. Sadly, with COVID-19, we can't even do that, in which case we're listed at home. By the way, this is what has been listed and shifted literally from the book. It's a great resource. And again, in the interest of time, I wouldn't be able to touch, do justice if I were to touch on each one of them. So the ones highlighted in green, I'll touch them on the surface to be able to give you an inkling or an idea as to what is possible, and then for you to delve further into what you think might be interesting for yourself. I'm happy to take on any questions. I'm sure Jesse or Kenneth will be happy to pitch in as well to be able to guide you through different strategies. So moving on, how do you extract value from rising markets? So as I said earlier, you could either go long call options or you could short put options. If it's a long call option, what I've done here on this slide is I've laid out a long September 116 call, and I also have a long futures position just to give you a sense of contrast. So I know many of you on this call right now, you do trade futures quite often. So many a time, I meet people and their first reaction to the word options are very dangerous, because if you short an option, the risk is unlimited. My only point to them back again is if you are trading futures, your exposure is unlimited in any case. So if you have a position, if you're trading stocks, your exposures are unlimited as well. So the prices could rally up or fall down in a very big way if you're having a long futures or a long stock position. With a long call position, so let's say your view is right, where would you most likely land in the area that is highlighted in green? So that's clearly profitable for you. If you were to be wrong with your view, and if you were to land in this region somehow, then your loss is the downside is protected. In some sense, the advantage of an option is almost like having a cake and eating it too, although you got to pay a premium for being able to achieve that. So with the same token, if you were to short a put option, you get to collect the premium upfront straight away. The premium is straight away in your pocket. But then what you need to then worry is if your view is wrong, if you end in this territory somehow, then your losses can start ballooning, and the losses can be much greater than the premium that you're collecting. In this case, the premium that you're collecting is 5 cents, is what I'm assuming as an illustration. But let's say the market comes crashing, you sold this put option when the market was trading at 116. Market came down to 104. your loss could be as high as 7 cents after offsetting the premium method. So how do you protect yourself against it? That's where delta hedging comes into play, which again is possible when you combine options and futures together. So moving on, how do you extract value from falling markets? So either you could go long put options or you could short call options. Here again, what I have done to be able to give you a sense is to compare the options payoff with the futures payoff as well. The assumption for this illustration is that the strike price is also, the underlying price is roughly at about 116. Therefore, this is at the money when you enter into the option, whether you're buying or if you're selling. So what does the profit region look like? So you are expecting the markets to fall, the price to come off. So when you bought the option, if the underlying was trading at 116 cents per kg, you expect the price to come off. Let's say so the price landed at 104 by the time this option expires. So if you had a futures position, your gain could be 12 cents per kg, but with the option, having paid the premium, it's limited, it's capped as a consequence of which, so it's only 7 cents per premium. But what is the advantage? If you were to be wrong, the market ends up rallying, goes up to 128. In the case of futures, you're exposed to a loss of 12 cents per kilo compared to options, wherein your loss is now capped to only 5 cents. Then again, you could have, futures position and unwind them. So that is, those are all possibilities. By no measure am I saying that options are necessarily always superior to futures. It's just that having options in your tool set gives you flexibility to express different views in the marketplace, gives you ability to play the market quite differently in a more sophisticated manner than if you were to just participate using only futures contracts. So moving on here with respect to short call options, there again, if you were to sell an option, sell a call option, you straight away get to collect 5 cents as premium. That's in your pocket straight away. And if you land in here, if the market settles at 104, the options expire worthless to the buyer, and you get to pocket your premium with all your money. Another beauty of options compared to futures is the margin element. There again, I'll perhaps take a minute to explain that. With a long option position, if you were to buy an option, you do not have any margin requirements at all. So which is where this chart, right? In this context, there is no margin for this option position. In this case, when you're shorting an option, again, depending on the delta of the option, the exchange will charge you a lower margin potential. But as and when the option becomes deeper out of the money for the deeper in the money for the buyer, which means out of the money for the seller, the margin levels keep increasing. So that's the downside of having a short position. But if you're having a long position, you don't have to worry about margin. And you can ensure that whatever profits you're gaining and the losses that are limited leaves you in a better position with respect to peace of mind. All right. So moving on. So profiting from high implied volatility. So this chart sets out a strangle position, a short strangle position. So imagine you're in a situation where the market is witnessing very high levels of volatility, and therefore buyers of options are willing to pay a high price for the option. So what does a strangle comprise of? Strangle comprises of two legs of an option. One is a short call option. That means you're selling a call at a strike lower compared to the put. In this case, you're selling a call at 112 and selling a put at 120. So the call at 112 has a payoff as depicted by the blue line. The sell of 120 put is depicted by the orange line. When you combine these two lines, the net payoff for the triangle itself is as depicted by the green line, right? So what does this payoff indicate for us? So it indicates with a high implied volatility, you're collecting a much higher premium, and you will make money and you'll get to keep that money provided as long as the underlying price does not shoot beyond the extreme, right? On the downside, as long as it doesn't drop below 106, on the tops, it doesn't exceed 126. This option structure, this triangle, is bound to make money for you, right? But then again, if the prices were to go beyond that, it's not that you're not necessarily exposed to a risk of a loss. you could still delta hedge and protect the commissions that you have collected as a consequence, which is what we'll touch upon in a later example. So moving on, profiting from large unanticipated moves. So what does a straddle comprise of? Straddle comprises of two option legs, and the long straddle would involve having to execute a long call position and a long put position at the same strike. So the long call is depicted by the blue line, and the long put is depicted by the orange line. And the combination of these two lines is what gives us the green line as depicted on the slide above. So essentially, in terms of profit region, so what are we expecting here? You as a trader, you know that there is a news that has broken in the market, as a consequence of which rubber prices are bound to move in a big way. But what you don't have a finger on is whether it will move up or move down. You know for sure it's going to be a big move, but in which direction you're not certain. A situation like that, let's say the market was trading at 116. You expect either the prices will go beyond 126 or fall below 106. In a situation like that, a straddle position will safely ensure that you will achieve and make. So in terms of profiting from mispriced options, again, as I mentioned previously, the ability to buy into a mispriced option is not always necessarily easy. In a well-efficiently traded market, to identify mispriced products is not always generally easy. But assuming if you have been able to identify a product that has been mispriced from a standpoint of volatility assessment or options premium assessment, let's walk through an example as to how you could possibly profit from such a situation. For illustration purposes, let's say on this day, on the 16th of April, you have managed to negotiate a long straddle and you have priced it at 6.4 cents per kg for 20 lots, meaning you have to pay $6,400 for this long straddle in absolute terms, with implied volatilities of 18% and 22% for long calls and long puts respectively. Your belief as a trader is that the actual realized volatility is going to be greater than the volatility that you have paid for to buy the straddle, meaning you have a view that the underlying rubber prices will move quite significantly, way above 20% implied volatility, which is what on average that you have paid for the straddle. So profiting from this mispriced straddle requires one to delta hedge to extract the value from the option. As the time to expiry shrinks with each passing day, and as the underlying prices change, the delta of the option changes too, resulting in delta hedges to be executed. A delta hedge portfolio is margin efficient, meaning it's a long straddle in place, and if you're able to delta hedge them, the margin required for those delta hedges tend to be generally very margin efficient. And finally, when the portfolio structure is optimized for delta threshold, meaning at what levels of delta do you hedge, and the frequency of delta hedges, how frequently do you consider delta hedge? Do you do it every hour, every day, every week? Again, there are no silver bullets around this. Each market behaves differently, and as a trader, that's where the judgment call kicks in to say what frequency and at how the period of intervals within which you delta hedge. Once it is optimized, these strategies can be profitably and consistently deployed to make money in the options market. Let's walk through an example, given what we have set out for ourselves, using the SGX portfolio analysis calculator that is embedded within the options calculator that I referred to earlier in the presentation. So I have blanked out all the various contract months. As you're aware, SGX lists 12 contract months. I have blanked out all the contract months barring the July contract month, which we all know expired on the 29th of May. And the two straddles have been, the two legs of the straddle has been populated as well. So just to refresh everyone's memory, so the straddle involves buying 20 lots of calls at 18.2% implied volatility and 20 lots of put at 22.1% implied volatility. So the long call commands a price of 2.4 cents per kg and long put at 4 cents per kg, totally 6.4, which in absolute dollar terms works out to about $6,400 for 20 lots. So on the day of establishing the straddle itself, let's call it day 0 on the 16th of April. So the long call gives a delta of 9.1, and the long put gives a delta of 10.5, minus 10.5, and a net delta of minus 1.46. And let's say on that day you decide not to execute any further trades to delta hedge that. On day 1, which is 17th of April, let's say the price of rubber moves from 116 to 117.2. It jumps up. As a consequence of which, the deltas of the straddle change. The long call is at now 11.5 and long put is at minus 8.5, opening up the delta of 3, positive 3, that needs to be delta hedged, meaning it needs to be neutralized. And that is done by selling 3 lots of the July futures contract at 117.2. Moving on to date 2, which is 18th of April, let's say the prices jump even further to 119.4. On that day, as a result of that price move, the long call delta is now at 13.8, while the long put is at minus 6.6, giving us a net delta of 13.8 minus 6.6 is roughly 7.2, and you've already hedged 3 lots of it. The net residual delta that needs to be hedged is another 4 lots, positive 4. That is achieved by selling an additional 4 lots in the market that generates a minus 4 delta, resulting in a delta of close to 0 at 0.15. Moving on to day 3, let's say the prices then fall. It drops to 117, as a consequence of which your net delta from all of these trades, meaning long call, long put, plus 7 lots of short positions in the futures market, generates a delta of minus 5. And how do you neutralize that? By buying 5 lots of futures, results in a portfolio delta of 0.58. Let's say on day 4, as a result of which, before I move on to day 4, I'd like to request your attention towards the profit and loss as a consequence of all these changes, right? Because the options are being marked to market. So the options itself is generating a loss of about $200. But through delta hedging, you have made close to $510 in profit, giving you a total P&L of $340 thereabout. Let's say on day 4, rubber prices come falling to 113.9. As a trader, you expected the market to be volatile, and the market is behaving in a volatile manner where the prices are swinging. Now, because of this price change, so when you compute the delta of all these positions, the long call, the long put, which is the long straddle itself, and net of 2 lots of short positions, results in minus 6 delta, which needs to be hedged by buying additional 6 lots to make the delta closer to 0, to bring the delta closer to 0. As a consequence of which, your P&L now sits at $672. Essentially, before we move on, when you delta hedge a long straddle, what it forces you to do is to essentially keep selling as the prices move up and to keep buying when the prices come down, which is fundamental trading 101 in order to make money, which is to keep buying when prices are low and keep selling when the prices are high, which is essentially what you get to achieve when you're managing when you're delta hedging a long straddle position. So as we move on this example, day number 5, so the price of rubber moves up to 116.7, as a consequence of which the aggregate delta from all these positions works out to be about plus 6, which is neutralized by selling an additional 6 lots at 116.7, by which your P&L is now jumping up to $1,000. On day 6, prices fall again, 113.3. As a consequence, your overall delta now from all these positions together is minus 7, forcing you to buy another 7 lots at 113.3. On day 7, let's say the prices jump up again. Markets are volatile. That's what you expected, and that's what you're seeing. The markets have gone up to 117.9. So as a consequence of which, all these positions put together is generating a delta of plus 10, which needs to be neutralized by selling 10 lots of rubber. Now, at this point, you're now already clocked in $2,500 in profit, that is a combination of, if you ignore these two here, this is the P&L from the option itself. You're losing about $300 from options from the straddle. But as a consequence of delta hedging, if you were to add all these up, that gives you a P&L of nearly $2,800 through delta hedging. Moving on to day 8, let's say the prices really jump up now to 122.5, as a consequence of which all these positions collectively gives you a delta of +8, which needs to be neutralized by selling 8 lots of rubber at 122.5. And on day 9, prices of rubber soften a bit, it comes down to 120.8, which collectively opens up -3 in terms of delta, which is to be neutralized by buying up 3 lots of rubber futures. At this point, if you notice, your profit as a consequence of delta hedging is $3,400, inclusive of the $600 that you're making in the mark-to-market value of the options position. And on day 10, let's say rubber settles at this point in time at 115.6. On this day, to be able to delta neutralize, you need to buy 10 lots of rubber futures at 115.6, because all these positions collectively generate a delta of -10, which forces you to buy at a lower price of 115.6. So roughly in 10 days, assuming if the market were to be as volatile as you had expected it to be, this would have generated a P&L of $4,600. By no means am I suggesting that delta hedging a long straddle position is a surefire means of making money in options market, but this is one indication or one possibility of how a volatile market can be used for your benefit by deploying a long straddle position and then layering it with delta hedging through the usage of futures to make money in the options market. This strategy is bound to fail, meaning it'll result in a loss if the volatility that you have paid for, the implied volatility that you paid for the long straddle, turns out to be much higher than the actual volatility that you realize in the marketplace. Should that were to happen, then this strategy is bound to lose money. Essentially, options, the first point that I'd like to leave with you is that options help you expand your toolkit. It helps you widen your toolbox, right? You can now take a view not only on the direction of the price, but the speed at which the prices change. 2, option beats are essential for traders, both from a risk management perspective and also for maximizing the value, extraction of value. 3, trading with options offers myriad possibilities, right? So what we have touched upon today, including the ones in Sheldon Nathanberg's book, is the basics, right? Is the imagination is entirely up to you as a trader as to what is possible. So, and which can be tailored to suit various market sentiments and different volatility regimes. So with that, I come to the last slide of my presentation. And before I open the session for Q&A along with Kenneth, I'd like to highlight that, as Ekmeng mentioned, options can be traded both on screen and via the OTC market. And I've dealt with all the 3 brokers myself personally, so Tanfac, Ginger, and Spray. And you have the contact details out there, and you have my contact details as well. And with that, I'll open the floor for questions.